we're going to start to talk about costs. We talked about revenue up to this point. How do we define revenue? How would you define revenue? What's a way you can think about revenue? What's revenue? Yeah.
When money before taxes, pretty much that you get to take home at the end of the day.
Not that you get to take home, but that you bring in. Okay? It's just the money that's coming in the door of your business every day. Now, you haven't paid any of your expenses yet. You haven't paid your rent, you haven't paid your employees, you haven't paid anything. Revenue is just like the number that's coming in. Now we're going to talk about the number that's going out. The money you owe, the checks you're writing, the people you're paying, stuff you have to buy in order to be a business. And so a lot of what we're going to talk about today is production and costs. The graphs start to get a little sketchy here. Okay? For some of you, this is going to be very, very uncomfortable. But we're going to begin building on graphs next week. Shit gets real in this class. Do not miss next week. There is no way I can make it up for you. There is no way that you can have the same experience as you will sitting in this classroom next week. If you can't make your time, your section, let me know. I'll see if I can find another time in another section for you to attend. It's that important to attend next week's lecture. Probably the most important in terms of micro. Okay? Chapter 4 sets you up for economics. Chapter 8 is going to set you up for micro. Okay? If you miss 8, you're lost for 9 and 10, and I'm not sure if you're going to. Okay? So please let me know if you're going to miss next week, and I can try and help you. Okay, production and costs in a firm. All right, so we talked about revenue, the money that's coming in. Now we're going to talk about the money that's going out. The important thing about the money coming in and the money going out is when you bring the money in and then you pay all of your expenses, what's left we call profit. Profit is what you stick in your pocket and you take home. It's what's left over, okay? So profit is the end game for any business. What's your profit? Revenue's good because that helps you pay your expenses, but what it's really all about is what's left over in the end, that profit, okay? So profit equals revenue, money coming in, minus costs, the money going out. A firm's, any company's objective is to maximize profits. And that's what the next few chapters are going to be about. These graphs are going to get ugly, but in the end, they're going to help us figure out how to maximize profits. And what's more important than that? Wow, there's a lot of things more important than that. But to a company, right, what's more important than that? You got to make profit or you won't exist, and then you can't do all the good that you want to do or whatever. Okay? So we break costs in economics, right, down into two different categories. Accountants don't care about both of these categories of goods. Accountants care about explicit costs. Economists care about explicit costs and implicit costs are two basic categories of costs. Explicit costs are those physical checks you're writing. They're those wire transfers you're doing. They're that money coming out of your checking account. Those are explicit. That's paying your rent. That's paying wages to your employees. That's paying for your supplies. That's paying for your resources. Anything you need that you're physically paying for, cash money, is going to be an explicit cost. But economists recognize there are other kinds of costs out there that might not necessarily cause an exchange of money, okay? And we call those implicit costs, which are also opportunity costs. So let's say that I decide to start a business, and I put a lot of time, energy, and effort into starting my business. That's a cost to me personally. Does it have to do with an exchange of money? No, but it's time and energy, and time is money, and so is energy. Okay? So the owner's time, they might not be getting an actual paycheck at first because a lot of businesses take a while, right, to get going and turn a profit. But the owner's time is going to be an example of an opportunity cost. Other thing that might be an opportunity cost is if I own a building and I decide to open my business in my building, what's the next best thing I could be doing with my building instead of using it myself? Renting it out to somebody else. Well, that's an opportunity, right? That's money I'm losing because I decided to use the building myself. So there's a cost associated with that, okay? Some of it's a time and energy cost. There could be actual money. But is that a check you're writing? If you are no longer renting out your building, you're using it for yourself, you're not writing a check. An accountant's not going to care about the fact that you're using your own building so you're not collecting rent. Because there's not a flow of cash out the door, but you are sacrificing something, right? It's a cost that comes in terms of sacrifice, which an economist cares about, okay? All right, so let's talk about 3 different types of profit. These first 2 are actually calculations, and normal profit is a concept, okay? Accountants have a profit calculation. They take all the revenue and they subtract only the explicit costs. Because it's the only thing they can track. They can't track the value of your time, the value of your energy. They can't care about that building you used to rent that you don't rent anymore. There's no way to keep track of that for an accountant. So accountants only subtract explicit costs from revenue, and then they'll tell you what your profit is. Or an economist is going to say, wait, there are all these costs you forgot, accountants. We need to backtrack and subtract out any implicit costs or implied costs. Those are opportunity costs, right? And so we can get a true picture of what the actual profit is. Okay? So just 2 slightly different calculations. The economists actually recognize implicit costs as costs, and they're going to subtract them if they have a monetary value. We're going to try and put a monetary value on it. We're going to get it subtracted. Okay? Normal profit is a concept. And it's a concept that you're going to see becomes a whole lot more real, a whole lot more relevant in the next chapter. We really can't talk too much about it here, except for I'm going to tell you mathematically what it looks like, so you can start to understand the concept of a normal profit. Next to normal profit, I would write economic profit equals 0. Normal profit's a condition that we recognize when normal profit equals 0. It's a condition. So if we earn a revenue, subtract out our explicit and our implicit costs, and we end up with a 0, we say we're recognizing a normal profit, the condition of normal profit. Again, this isn't going to make a whole lot of sense to you right now. It'll make a whole lot more sense next week. Good? When economic profit equals 0, you're recognizing the concept we call normal profit. Okay? All right. So let's do a little calculation. Okay? Let me kind of set you up for this. This is out of your book. Okay? So this is an example that's in your book, but I have to kind of give you the story behind this breakdown. So there's a woman named Wanda. She quits her job. She was making $50,000 a year in order to open up the Wheeler Dealer Corporation. She also is using her garage. She used to rent out to her neighbor to store his boat. She used to rent it to him for $100 a month to store his boat. She has now taken back the garage and she is using it for the operation of the Wheeler Dealer Corporation. She also took money out of a savings account. A savings account that was earning interest. Interest, that's the money you earn from putting your money in the bank, right? And so when she took the money out of her savings account, she no longer is earning interest. So that's sort of to set you up for some of these implicit costs you're about to see, okay? So Wanda's revenue the first year in 2010 was $105,000. She had explicit costs, only 2. She paid an assistant $21,000, and she bought material and equipment for $20,000. those are explicit. She actually wrote checks for those things, right? Sent wire transfers. And so an accountant would say, Wanda, you made $64,000 in profit this year. You took your revenue, you subtract your explicit costs, and your profit, the money you're taking home is $64,000. The economist would say, wait. She gave up a $50,000 job. Is that not a cost? In order to start this business. If she went back there, she could get her $50,000. But she gave it up. It's an opportunity cost. It's the next best thing to what she's doing right now. Okay? So an economist would say, wait a minute. You have got to subtract out the salary she could have been earning in her other job, the next best thing. And you have got to consider that she lost $1,000 on interest from the money she took out of the bank. And you have to consider that she gave up $1,200 in rental income in order to run this business out of her garage. So an economist would calculate profit and say, your profit's really $11,800. Huge difference, right? Should Wanda continue to operate Wheeler Dealer? Yes, no, and why? Yes?
Yes, because she's making $11,800 more than she would have when she was not when she had it like invested in like garage rental and her other job.
Perfect. That's the right answer. Okay? That even after we accounted for everything Wanda gave up in order to start this business, her job, her savings interest, and her garage rental income, she still is making an additional $11,800. Yep.
So if it was a negative number, she obviously then would want to not continue doing the,
She should try and go get her old job.
yeah.
Yep. Does that make sense to everybody? Yeah? An accountant wouldn't think about this stuff. But can you see how it's a valuable thing to think about? What you gave up? Sure it is, right? It gives you like a more well-rounded picture. All right. So now we're going to talk about resources. We know what resources are. They're the things that go into making other things. It's the stuff we use to make final goods and services. What are the 4 categories of resources that we have? Natural. What's that? Human capital, so like labor. Yep, labor. Entrepreneurial ability and capital, right? Okay. Capital is usually machines, equipment, factories, buildings, things like that, okay? So there's also 2 types of resources when it comes to calculating production costs. When you think about how to produce things, you have to consider 2 different types of resources. Fixed resources and variable resources. Because those resources come with costs associated with them, okay? Variable resources can be very quickly, the amount you're using can be changed quickly to change the output rate. So you can change the amount you're using to change the amount of stuff you're making. Those are variable resources. So if you're making furniture, your variable resource would probably be lumber. You want to make more, you can easily increase the amount of lumber you're using, or vice versa, right? If you don't want to make as much, you stop buying as much lumber. So that's a variable resource. A lot of times, labor is variable. If you don't need as many people building furniture, you're going to lay them off, you're not going to schedule them. Vice versa is true. If you need more people, you're going to increase the amount of labor that you're employing. Okay? Fixed resources cannot be altered easily. It doesn't say they can't be altered. It says they can't be altered easily. They can't be changed quickly and easily in the short run, right now. What things is it harder to change besides the amount of lumber and the amount of hourly employees?
Rent for your shop.
Good. Rent for your shop. It's hard to change your rent. It's hard to change the size of your factory quickly and easily. Right? Can you do it? eventually. It's really difficult to do now. What else might be hard? What about like management? Yeah, here's the thing, is even in the slow times in your business, let's say you have a seasonal product, you can't just lay off your managers, can you? No, you can't, because you need them when the busy season picks up. So, while your hourly labor is very variable, your sort of management labor is fairly fixed. And so they're a little bit harder to get rid of. And so you can see that you have resources that fall in two different categories or might overlap altogether. Okay? Short run versus long run. So this is kind of a hard concept in that it's very conceptual, it's kind of random, and it's a little difficult to wrap your head around. Short run versus long run, when we're talking about production and costs, has to do with resources. As long as you have one resource that is fixed, you're in your short run. So if you have a building that you've taken a lease out on and you have it for 8 more months, your short run is 8 more months, right? So as long as you have one resource that's fixed that you can't change, it's that period of time that you're sort of locked into some given resource, okay? So in the short run, at least one resource is fixed. You only need one fixed one, right, to keep you in your short run. In the long run, no resource is fixed. So when you pass 8 months, theoretically, right, you can go rent someplace else and you're no longer in that lease that you had 8 months left of, okay? Short and long runs differ between firms and industries. Okay, this is kind of obvious, but I'm going to give you sort of some examples on really short runs and really long short runs. If you have a law firm, there's 2 lawyers in your law firm, you rent a 1-room space by the month, what's your short run? The remainder of the month, right? And then you can make a different decision. The 1st of next month, you can move into another space. Nuclear power plants take 10 years to build, an entire decade to build a nuclear power plant. If you are operating a nuclear power plant, how long is your short run? 10 years. So you can have the remainder of a month or 10 years be your short run. It's going to vary depending on the industry and the firm type that you're dealing with. Does that make sense to everybody? As long as you're locked into a resource. Okay? So how quickly, essentially, can you change your resource? All right. So now let's talk about production. Making stuff. Okay? Every firm makes something. Even if it's not tangible, even if it's a service, that's production. You're producing a service. So you're producing haircuts, you're producing whatever, clean houses, or whatever you're producing, whatever your service is, right? Accounting services, you're producing tax returns, whatever it is. Total product is exactly what it sounds like. It's your total production. Now, I would have to give you a time period. I would have to say, what's your total product for the day? What's your total product for the week? What's your total product for the month? And then you would add up your total production. How much did you make? It's that easy, right? Everybody should know how much they're making over some given period of time. The production function is a lot simpler than you think. It's the relationship between the amount of a resource employed and total product. If I hire one more person, how much will they increase my total product? If I buy one more tree, how many more chairs can I make? It's the relationship between purchasing a resource and how that changes your ability to produce, how that changes your total production. That's easy enough. You know that hiring one more person should increase production. That buying one more tree should allow you to build more chairs, right? That's a natural relationship. Marginal. What does the word marginal mean? If you were going to find a synonym for marginal, what would it be? It's the change. It's the change in something. It's the additional. It's what you're adding. It's usually referred to as the change. Okay, marginal is change. So if you're looking for the marginal product, you're looking for a change in production. Well, production changes when you employ resources, right? So the change in total product when the use of a particular resource increases by 1 unit. If I hire you, what will you do for me? If I buy one more tree, what will that tree do for me? What you're going to find in this class is it's not consistent unit by unit. If I hired 2 people in this room to work for me, I promise you they will not produce the same. Right? Fact. Okay? And so understanding that what's really important is what you alone can add to my production, not as a collective how much you produce. So you can look at a factory and you can say, all the people in my factory make 1 million units a month. Yeah, okay, that's good to know. How much does that person add to my production? They add 2 units a month? No thank you, right? I don't want them. Worker number 1 might add 100, worker number 300 might add 2. Like, that's something you need to know, right? Yes, it is something you need to know. You probably haven't thought about it. You might not care about it. One day you'll care about it, right? I promise. All right, increasing marginal returns. Increasing marginal returns says, and I'm going to show you an example that I think is going to be helpful, takes place when the marginal product of a variable resource increases as each additional unit of the resource is employed. It sounds like a whole lot of nothing, but it's a whole lot of something, okay? Let's say you own a pizza restaurant, okay? And it has a kitchen in it. And the kitchen has a couple ovens in it, okay? How many cooks are usually in a pizza kitchen? Yeah. 2, 3, 4. That's right. There's a reason it's 2, 3, 4. It's a very specific reason there's 2, 3, 4. Right? Let's talk about that. Okay? There's a reason it's not 1 and there's a reason it's not 10. It's not rocket science, it's just simple economics. Okay? So, you got yourself a pizza kitchen, you hire 1 cook for your pizza kitchen. Okay? You got 1 cook in the kitchen. That cook alone, let's say, can produce 50 pizzas out of that kitchen during any normal shift. Okay? Pizza cook 1 gives us 50. There's a reason there's not 1. What's the reason there's not 1 pizza cook in a pizza kitchen? It's too slow. They have way too much to do, right? There's just too much going on for them to manage the whole process themselves. The efficiency created by hiring a second pizza cook is profound. So, we hire a second pizza cook. Together, they can now make 150 pizzas. So 2 pizza cooks can now make 150. Wow. How much did that second pizza cook add to my production? What's the marginal product of that pizza cook? 100 efficiency created in the kitchen as a whole, right? But can you see that this more than doubles? Right, okay? It's a big pizza kitchen, okay? So we're gonna throw cook number 3 in there. Remember we said 2, 3, 4. Yeah, it depends on the size of your kitchen, right? I would say the average is about 3. And let's say that these 3 cooks together can turn out 300 pizzas in a shift. What's the marginal product of that cook? 150, right? It's the difference. It's what that cook, adding that cook, added to production. Yep.
Is the marginal product always the second and third, first and second, or can be first and third, first and fourth?
No, it's always just the next unit. That's a great question. So it's always what we're adding, what we're changing. Good. It's a great question. Okay? So we experience increasing marginal returns. That's what we experienced. When we went from 0 cook to 1 cook, we added 50. When we went from 1 cook to 2 cook, we added 100. When we went from 2 to 3, we added 150. Do you see how our marginal returns are increasing? Increasing marginal returns. That's what we're experiencing right here, okay? Takes place when the marginal product of a variable resource, that's our pizza cooks, increases as each additional unit of the resource is employed. That makes sense, right? Okay. There's a reason there's not 10, right? We're going to talk about that next. Okay? And it's something called the law of diminishing marginal returns. As more of a variable resource, that's our pizza cooks, is added to a given amount of another resource, that's our kitchen, marginal product eventually declines and could become negative. Just bear with me. We're going to talk about these pizza cooks again, okay? Let's say I hire pizza cook number 4 in my kitchen, and my production goes up to 400. What's the marginal return of cook number 4? It's 100. Is that still a lot of pizzas to add to production? Yeah, it is. But are my marginal returns diminishing? Yeah, we've peaked out here at 150, right? We increased, and now this is still positive, and you still might want to hire cook number 4, right? You're going to have to decide that. It's a lot more complicated than that. But I can tell you that diminishing marginal returns are starting to kick in right here. And then as you start to add more and more cooks, right? What's your problem? Too crowded. Because you have added more of a variable to a given amount of another resource. Your given amount of another resource is this capital we call a pizza kitchen. Those are the walls, right? You can't change that today. That's a fixed resource for you. So at some point there's going to be so many cooks in this kitchen, literally, they're going to start putting up negative returns, right? Yeah, kind of a dramatic example. Every firm, every company, every operation experiences these phenomena, right? This increase, right? Increasing marginal returns, and then diminishing marginal returns kicks in, and if you keep going, those are going to turn negative. You're going to stop at some point, I hope, and say, that's one cook too many. Does that make sense to everybody? Okay. All right. So here is, I know it looks like a lot of numbers. It's really simple. It's a whole lot more complicated than this. Just bear with me, okay? Just try and stay focused on what we're looking at. There's just going to be lots and lots of numbers, but they're not difficult calculations. They're not difficult numbers to understand, I don't think. So the next example in your book is the Smoother Mover Corporation. It's a moving company that has 2 resources. Just keep things simple. They have a moving truck, and they have movers. Which one's fixed? Which one's variable in terms of resources? Truck is fixed. The movers are variable. It's easy. call another one in or tell one just to stay home for the day. Good? But your truck's your fixed resource. Okay, units of our variable resource. That's our workers, right? We can hire one worker for the day, 0 actually, 1, 2, 3, 4, 5, 6, 7, 8. Good? The total product, the total tons we can move with this number of workers has been given to us. We don't have to calculate it, we don't have to figure it out, it's been given to us, okay? So if we hire 5 movers can move 14 tons of goods per day. Everybody following me? Okay. This last column is the marginal product. How much does that worker change productivity? Well, all of these workers add to productivity except when we get right here. Worker number 7 actually doesn't increase our production at all. Can you imagine what you do with 7 movers and 1 moving truck? That doesn't make sense, does it? There comes a point where you're making 2 trips just to move your movers, right? And it cuts down on efficiency. So I'm pretty sure, unless this is like my brother, I'm not going to hire mover number 7. Because mover number 7 doesn't add anything to my production at all. And I know I'm not taking mover number 8, right? Because mover number 8 actually starts to decrease production. So I'm paying somebody's wages and they're decreasing production. That person doesn't make sense, right? Probably these last 2 don't make sense. Okay. Everybody good with this? It's pretty simple data. It's something that all firms, all factories, all businesses keep track of, right? How much does that person add to my productivity? If they lay you off, it's not personal. Well, it might be personal, but it's usually not personal. It just usually is a function of the numbers, right? You're just not adding enough to production for whatever reason. My ego falls into it. It's not that 7 or 8 are bad movers. They just don't make sense because we only have 1 moving. Okay? Okay. This is the same data you just saw, but I graphed it. So students are like, oh my God, you graphed it. Yeah, it's okay. It's the same data. It's exactly the same. Okay? It's going to be okay. Okay. So right here, this is those same workers, right? Yep. And this is their marginal product. How much do they add to production? No, I'm sorry, that's total product. This is marginal product. Total product. And so this is us going from 3 tons moved to 5 to whatever, to whatever, to whatever. And then where did we peak out? What was the maximum number of tons we could move without a 1 moving truck? It was 15, right? And it leveled out, remember, and I said, I might hire worker number 7 if he was my brother, but he's probably not going to get hired. And then worker number 8 actually decreased total product, down to 14. So this is that same data, it's just we plotted it on a curve, just because you'll see, okay? This is marginal product. So this is how much did that worker add to my production. Well, worker number 1, it's down here, right, could move 2. Worker number 2 actually added 3, and together they moved 5. So this is just that marginal, it was that second column in the middle of that last slide, right? It was really worker number 3 that maxed out on the marginal production, the additional products they could add. And then we saw what kick in? The law of diminishing marginal returns kicked in. It doesn't mean I don't want these workers. That's not what it means. It means that we're trending in the downward direction and I need to figure out where to stop. Okay? And this right here is worker number 8 with that negative marginal return. Same data. That was the last put positive, so diminishing marginal returns, but they're still positive, right? And then we got the negative marginal returns. If there's a question on your exam, it gives you a bunch of data and says, where does the law of diminishing marginal returns kick in? You're going to tell me with which unit? Which unit? Or between which units does diminishing marginal return kick in? Between 3 and 4, unit number 4, okay? Positive, diminishing marginal returns kicks in right here with worker number 4. A lot of students are tempted to give me this negative. Diminishing just means it starts going down for the first time, okay? Just a little disclaimer about perhaps an exam question you might see, okay? All right, costs in the short run. Fixed costs, variable costs. So you know what a fixed resource is. You know what a variable resource is. Fixed and variable costs go with fixed and variable resources. Okay? So your rent, which is a fixed resource, your building's a fixed resource, also comes with a cost that's fixed. You have to keep paying it every month. It's not going to change. Okay? And then your variable costs go typically with your variable resources. You hire another person that day, you have to pay them more money, that's variable costs. You don't buy a tree, you buy another tree, those are going to be variable costs as well, they go with your variable resources. That's not 100% always the case, but most of the time variable resources go with variable costs and fixed resources go with fixed. Let's talk about something else in your firm that might be fixed or variable. So we've talked about fixed being your rent, maybe your manager's salary. We've talked about variable being labor, hourly labor, or maybe resources like trees or oil or something like that, depending on what goes into producing your goods. What else might be a fixed or variable resource? Everything falls in one category or another, or perhaps overlaps the two. What other expenses do you have in the factory, let's say? Usually that's going to be variable, because if they're hourly, you can tell them not to come in today, or you can say you come in and work an extra shift. Yeah. It's your management salary that usually doesn't work that way, right? They get a flat wage or flat salary, a flat salary for the year, no matter how many hours they work, right? What else? What about utilities? They're actually both, right? A lot of them are variable, right? Because you fire up that factory and you turn on the lights and people are flushing toilets and, right? And most of it's variable. Is there a minimum amount of resources that even if nobody's in your factory and nobody's producing, is there a minimum amount of utilities you'll have? Yeah. You can't let the pipes freeze, right? You've got to keep water flowing through the system. So they're sort of both. Most of it's variable, some of it's fixed. So you are all right, no matter whether you're variable or fixed. Things like your security system, right? That's going to be fixed. Health insurance for your employees, whether they're working or not, depending on the deal that you've made with them, you're probably still paying medical insurance and things like that, even if they're on vacation or even if your factory shuts down for the week or whatever. So all costs are going to fit in one or the other of those two categories. All right, total costs. Again, it's really simple, like this is a lot of words for a lot of nothing. But total cost, add your fixed and your variable costs together and you're going to get your total cost. This is it, right? Add them all up. Fixed and your variable, and you're going to get your total. No big mystery there. When output is 0, when you're making nothing, there's still one category of cost that you have, which is what? It's fixed. Even when you're not making a single unit of a single item, you still have fixed costs. That's an important thing to remember as we go through these next couple slides. Even if you're producing nothing, there are still costs involved. Okay? Pretty important thing to recognize. Marginal costs, just like marginal product, is a change in cost. How much is cost changing as you produce an additional unit of goods? If you build a $2 billion automobile factory and produce 2 vehicles, what did each vehicle cost you? $1 billion. That's what those first 2 vehicles cost you, was $1 billion a piece. Because you have all of that fixed cost that had to be assigned to just 2 vehicles. When you crank out car number 300,000, right? You produce a lot more vehicles out of that factory. It changes what vehicle 300,000 costs you. It's a whole lot less expensive than car number 1, vehicle number 1. If you only made 2, they would each cost you $1 billion a piece too. So, does it make sense that every unit that gets produced could essentially cost you a different amount of money to produce? It's true. It's true. It's crazy. But it's an interesting thing to think about if you're producing goods and services, is that potentially each unit you produce costs you a different amount to produce. Okay? Let's say you produce something really tiny that you can't really say, oh, that towel costs 43 cents to produce, right? You wouldn't do that. You'd make 1,000 of them. You'd figure out what it costs you to make 1,000, and then you would divide it. Okay? If you're making something small and inexpensive, you don't track how much each one costs you. If you're making huge dump trucks, you're probably tracking what each one costs you. If you're making something smaller, a lot of times we make them in what we call batches. So let's say the batch in your factory is 1,000 units, and that's how you keep track of costs and things like that. You package them in sort of these $1,000 or these 1,000 unit increments. Then you would figure out what the change in your total cost was. Like the additional cost for this 1,000 units was $1,000. And then you would just do the division and say, they cost me $1 a piece. And then you would do your next batch of 1,000 and figure out what those cost you per unit. That makes sense if you're making something smaller, right? Yes, it does. All right, don't panic. Lots of good stuff here. So some of it you've already seen. Okay, we're back to Smoother Mover. Back to the moving company. You have movers. You have 1 truck. But we have a whole lot more information now. Here's your tons moved per day. You've already seen that. Here's your workers per day up to 6, because we said we didn't want 7 or 8 anyway, right? So let's just stop at 6. We know we don't want 7 or 8. Let's figure out if we want 6 or 5 or 4 or whatever, okay? Our fixed cost. So no matter how many units we move, our fixed cost is $200. Where does that cost come from? The moving truck costs $200. Okay? $200, it looks like a day. That's probably about right to lease a big, huge moving truck or whatever. Okay? So no matter how much you move, you have fixed costs of $100. Your variable costs, what would those costs come from? The movers. How much do the movers cost you per day? Can you tell? $100 a day, right? 4 movers is going to be a variable cost of $400. Math's really simple, $100 per mover. Total cost, how do we get total cost? Fixed plus variable. So 200 plus 600 gives you 800. 200 plus 500 gives you 700. What's your total cost? Easy. one's a little trickier. This is that marginal cost we were talking about, where I said, does it make sense that every unit doesn't actually cost you the same to produce? I'm actually going to show you that right now, okay? Marginal cost, you got to memorize this equation. It's not that hard, okay? Marginal cost, the way you calculate it is you find the change, that's that delta, right? You find the change in total cost and you divide by the change in quantity produced. How much did my cost change? How much did my production change? What did those units cost me? That's what you're trying to figure out, okay? What is the change in total cost the whole way down? 100. It represents that additional motor all the way down, right? So that change, the numerator, change in total cost, is always going to be 100 in this case. Not in every case, in this case. So our numerator in this calculation is always 100. Our denominator is the change in quantity. Well, quantity is here. How much tonnage did you move? Okay? So for this first one, we add worker number 1. It increases total cost by $100. How many additional tons did worker number 1 add over worker number 0? What's the change? It's 2. So the change from 0 workers to 1 workers is from 0 units moved to 2. 100 divided by 2 gives you 50. Oh, you're stretching? All right. So the next one, we go from 1 to 2. We know the change in total cost is still going to be 100 because we just added another mover. But how much did worker number 2 add to our total? We went from 2 to 5. So they added 3. 100 divided by 3 gives me 33. What that means to me is those first 2 tons cost me $50 per ton to move. And that next group of 3 tons I got from adding worker number 2 only cost me $33 per ton. Where's my profit going to be bigger? On which tons? Tons 3 through 5, okay? Over those first 2 tons. Those first 2 tons had a higher cost than those next tons. I'm actually going to make more money on those next ones, right? Yeah. So let's talk about worker number 3. Worker number 3 adds another $100 to my cost, my overall total cost. But how much do they add to my overall production? What's the change in quantity? This time it's 4. 100 divided by 4. We went from 5 to 9. Change of 4. 100 divided by 4 gave me 25. Those are cheap tons to move, right? Profit's big on those tons, okay? And then you can see we keep going, right? And you can see what happens to the cost per ton. We get down to worker number 6. Worker number 6, that ton costs us, they added 1 ton to production. That ton costs us $100 to move, because that's all worker number 6 gave us. They only added 1 ton to the overall. It cost us $100 to employ. That ton costs us $100. Good? What is our total cost when we don't produce anything? It's 200. It's our fixed cost. We have to pay our lease payment on that truck, even when we don't have any jobs, right? Yeah. Just like we have to pay the rent when we're not producing anything in our factory, etc. Good? Not difficult. We'll get there. Okay? All right. Same data. Just going to graph it. Okay? All right, this first line here, kind of a stupid line. Fixed cost. It's a line at fixed cost. If we were going to graph that second column on the previous slide that said $200 down, at any quantity, fixed cost cost remains the same. And I think your author just wanted to illustrate that on this graph. It's gonna be $200 no matter. Let's keep at it. Variable cost. That's those movers, right? It's not perfectly sloped up because not at these different tonnages, we had different numbers of movers, right? And so that's our variable cost if we were gonna graph it. That's the wages for the movers. And there's our total cost. Total cost is variable plus fixed, gives us total, right? So if I was gonna graph total cost, or the second to the last one on the previous graph, it would look something like that. If I see a total cost curve, even if there's not a fixed cost line right there, could I tell what my fixed costs were by looking at my total cost curve? It's where it starts. Because when production is 0, my total cost starts at 200, and I know 200 is my basis. That make sense? Okay? Fixed plus variable gives me total. Same is true on a graph. Okay? Do you see this arrow and this dashed line between these 2 points, between the variable and the total cost curve? The vertical distance between variable and total throughout the entire graph is going to be equal to what? 200 fixed costs. Okay. The vertical distance. If we were to measure the vertical distance at any point between variable and total, we would get 200 because variable plus fixed gives you total. You're going to stack those numbers on top of each other. All right. And here's marginal cost. This was that last one, right? That last column. We started at 50, we went to 33, 33, we went to 25, and then we started heading back up, and we got back to 100, right? The marginal cost curve will follow you, chapter after chapter after chapter. It's probably the biggest takeaway from this chapter is sort of getting you to experience the marginal cost curve. The marginal cost curve, this one is a little short on the upswing, but a lot of times when you see it, because we're going to be doing things on bigger scale, bigger graphs, not just one little moving company, it always has like a check mark shape, okay? Always has a check mark shape, okay? So when I say the check mark, you'll know what I'm talking about. It's the marginal cost curve. It would continue up. If we had a bigger operation, if we were talking about bigger numbers, okay? Average costs. I don't want you to overthink average costs. How do you calculate an average? Take some amount and you divide by some quantity to see what the average is. Right? This is easy. Don't overthink this. So if I'm trying to come up with my average variable cost, I come up with my variable cost, divide by some quantity of units, and I get the average variable cost per unit. Nothing sophisticated. Average fixed cost, I take the fixed cost, in this case my 200, I divide by my output, the number of tons I'm moving, that's my average. That's simple. These are useful pieces of information, okay? Average total cost divided by output. So your $800, your $900, whatever it is, you've added your fixed plus your variable gives you total. Total divided by your output gives you average total cost. These are good, right? This is good information to have to understand how your average prices are changing over quantity. Then I'm going to show you how, at least with average variable and average total, we're going to put those with that marginal cost curve, and that's going to give you more data than you ever wanted to know, ever had hoped to know about finding profit maximization. Okay? Okay. So don't look at this for a minute. Okay? what is the relationship between marginal numbers and average numbers? So marginal numbers would be how numbers are changing, and your average is more of an overall. Think in terms of your GPA or major league batting stats. For some of you who are like, yeah, I understand how batting stats are calculated, or costs, which sort of brings us full circle. How does your semester GPA affect your overall? How does your this game's batting average affect your overall? Well, if this semester's GPA is higher than your overall, what is it going to do to it? It's going to bring it up, right? The same goes for a low GPA. If your low GPA is lower than your overall, it's going to bring your overall down. Marginals drag averages. Because your marginal, right, has an impact on your overalls, the same goes for costs. If your average costs, if your marginal costs are rising, what is that going to do to your average costs? It's going to pull it up, right? It's going to rise too, okay? So it's just keeping in mind that marginals change averages and that they drag them with it, okay? All right, if your marginal is the same as your average, if your GPA is a 3.3 overall and you get a 3.3 in the semester, right? It's going to stay the same. Okay. When marginal cost is less than the average, it's going to pull it down. When marginal cost is greater than the average, it's going to pull it up. And I will show you these U-shaped curves here. Very good with that concept. I think everybody understands what happens to your GPA when you have a good semester. A bad semester, the same thing happens with costs. When you have a bad round of costs or a good round of costs, it also changes your average. Your costs are the same. Okay? All right. So, already seen most of this. Okay? I know. Tons moved per day, you've already seen it. Variable costs, you've already seen it. Total costs, you've already seen it. Marginal costs, you've already seen it. We're just going to throw some averages on. Okay, the two averages that really matter is average variable costs and average total costs. Why does an average fixed cost matter that much? You can't do anything about it. It's fixed, right? Like, it's good information, except for what does it mean? I don't know, your fixed costs aren't going to change anyway, so we don't really need to spend too much time on fixed costs, okay? Average variable costs. Variable costs divided by the quantity moved gives us average variable costs. That's easy. Average total. What's your total cost? Divided by your quantity. 400 divided by 5 gives us 80. It's that easy. Simple, right? Averages. Take your total costs or your variable costs and do the averages straight across. You can see that just like marginal cost dips down and goes back up, average variable dips down, goes back up, average total dips down and goes back up. It's because of this that happens. Yes, late, 1 example.
We have your video stopped. Yeah.
Oh.
It says low batteries. I think it stopped.
Thank you. I appreciate that. Okay? And it's because of this, right? It's because we experience increasing marginal returns where we're getting a lot of bang for our buck, and then diminishing marginal returns begins to set in and we're getting less bang for our buck. Good? So we ramp up production by adding resources and then it begins to fall off. This happens for that same reason. It's just the cost part where this is the production part. This is showing the increase and decrease in production. Well, that goes with, right, watching cost per unit drop, but then go back. Okay, so if I was going to graph average variable cost. You saw those numbers on the previous chart with all that other data. If I just graphed it, this is what it would look like. Does it make sense that average total cost sits above average variable cost? Yes? What would we say the vertical distance between these two would be? Be specific. Average fixed cost, right? Average variable plus average fixed would give you average total. Yep. That's a fact. How interesting that average fixed goes from being a very large portion of your costs to a progressively smaller and smaller and smaller portion. Why is that? What's the math? The fixed costs are staying the same, aren't they? $200 is staying the same, but as you make more and more, this number keeps getting bigger and bigger and bigger, which makes your average get smaller and smaller and smaller. Okay? All right, let's add our marginal cost curve on here. This is the graph you are going to see over and over and over and over again. Really, what we've done in this whole chapter is showed you how to get that, so that you have some understanding of where those numbers come from, where that data comes from. The marginal cost curve is a check mark that always intersects average variable cost and average total cost on a graph. Okay? Because your marginal drags down your averages when it's below it, or drags up your averages when it's above it, what do you think is significant about these 2 points of intersection here? Let's look at the ABC, the average variable cost curve. What do you think is significant about this point right here? It's the lowest point. Because when the marginal is below, it's pulling it down with it. But the minute the marginal goes above, just like your GPA, it begins to pull it up. So that is the minimum point on each of those cost curves, is that point of intersection. Okay? Let me see. Oh, we're almost out of time. Hang on. This concept's good. Okay? We're going to get through this slide and then you've got to do the rest on your own. I know today's a lot. Next week's even more. Okay? So let's talk a little bit about short run versus long run. Okay? Short run, you have one fixed resource. Long run, you don't have any fixed resources. Here's why this is such a highly conceptual idea, this short run, long run concept, is because if you are in a law firm and your lease ends at the end of the month, when are you going to try and find yourself a new lease? Are you going to wait till the first of next month to find yourself a new lease? No, you're going to do that somewhere before your lease ends. Did you ever get to a long run, or did you just go from short run to short run? Exactly. Long run is what we call our planning horizon. It's the time we think about. One day, when this lease is up, when I can build a bigger factory, that's what I'm going to do. The fact is, I have to start putting that stuff into operation before that day comes. It's like saying, I'm going to do that thing tomorrow. When you get to tomorrow, it becomes today. You ever really get to tomorrow? Because tomorrow will become today before you get there. Yeah, right? You go from short run to short run to short run. You use the long run to plan in, but the fact is you don't really want to gap. You don't actually want a factory that you can't get into. Okay? We need the rest of his lecture on your own, so